Einstein said that, right? If you understand the concept, you can even explain it to a 5-year-old in some lines. So maybe on those same lines, we just want you to summarize your protocol, how it is. Cool. So I think we'll quickly go through, again, just to give context to everyone, we'll be following the order which is already there in Notion, which was there for your week 3 coursework. So I think the first name I can see here is Roshan, and I don't think he did it yesterday. Roshan, you want to start?
Yep, sure.
Cool. So I'll start the timer. Let's try to keep it within 3 minutes. And obviously everyone need not worry, even if you're not understanding, we'll be sharing the slides with everyone. Like basically I'll put down the links in the Notion itself maybe, or I'll just share a Google Sheet.
Shall I start now?
Yeah. You can share your screen.
Is it visible for you guys?
Yeah.
Okay, cool. So guys, I'm gonna talk about Uniswap. As you know, this is the OG DEX. Also, it's a reminder for you guys to read Vitalik's blog. It's gonna have so much alpha content. It's a brief overview of what we're gonna talk about, what we're gonna cover here. So I'm gonna start off with what are market makers. Market makers are like agents in a market that provide liquidity for any trade to take place. They usually do it because there might not be organic liquidity in the market. Those are usually the agents that's present in traditional markets or like centralized exchanges. So in context of DEXs, they have automated market makers. Like so automated market makers are basically the algorithmic agents that almost does the same functions of market makers. So they provide liquidity in forms of liquidity pools, which basically allows users to add or remove liquidity. So what Uniswap does different is that they introduce this concept called CFMM. Stands for Constant Function Market Makers. It's said to be DeFi 0 to 1 innovation, like a radical new thing out of thin air. So what CFMM is that it defines a relationship between the quantities of tokens in the pool. Like in Uniswap, it's that the product of quantities of 2 tokens in the pool is always a constant, and that's going to be the deciding factor for the price of the tokens in the pool. So it just defines the relationship between 2 tokens, and they are path independent in the sense that in centralized exchanges, you're gonna be seeing these order books and all the other variables that decide how the price of the tokens would be. But in DEXs like Uniswap, the price is only going to be dependent on the ratio of the tokens in the pool, which is this equation here. And these are the new features included in Uniswap v3. These are concentrated liquidities that concentrated liquidity basically means that you're going to be providing liquidity for a certain price range like 0.99 to 1.00. Whereas in other exchanges or older versions of Uniswap, the liquidity would be distributed along the price range like $0 to $1. So you can provide liquidity for small price range, and then that's actually a better allocation of capital if you think. And active liquidity is that if the price goes beyond the range where you provide liquidity, then your liquidity will be taken out, and you basically avoid permanent loss. You can keep multiple limit orders, which are like you can provide liquidity 0.99 to $1 or any other price range. And since these are custom price ranges that any user can create, these tokens will be represented as NFTs. Like all the LP tokens will be represented as NFTs rather than ERC20 tokens, because these are custom price ranges that you create. So it's basically
Roshan, if you can take like the next 30 seconds to sort of conclude.
yeah, sure.
Yeah.
This is the last slide. So it's a basic very efficient capital allocation method, and yeah, I guess you guys got the point. So that's it. Does anyone have any question?
Anyone? No questions?
Did you guys understand? So I was rushing a bit.
All right, I think we can like sort of share the slides later on. I can understand may not be most efficient thing, but I think we can do that.
Okay.
Cool. Faisal, you want to go next? Do we have Faisal on the call?
Yep, sure, Aniket. Am I audible?
Yeah, you're audible.
Awesome. I'll just share my screen. Let me know if my screen is visible.
Yes, it is.
All right. So I think I'll just start off. So we already know what liquidity pools are and what AMMs are. So I'll just talk about Uniswap's constant product formula, which I think Roshan already explained, but a bit more deep dive. So this is basically what X into Y is equal to K looks like. So the agenda of this curve basically is that it make sure that there's liquidity always. So it would go to an infinitely large amount before it even hits zero. However, this formula doesn't work very well with stable coins, because we ideally expect stable coins to have a one-to-one mapping. So I think yesterday I saw how much it would take. So if I were to swap 1 billion DAI, I would get around 600 million itself. So that's like a 40% slippage, which is definitely not cool when the price of both of them was just $1. So that is the problem with swapping stable coin token in Uniswap. So that's where Curve comes into picture. So Curve is basically a DEX that focuses on stable tokens, or similarly priced tokens. So it provides hyper efficiency because it provides low to negligible slippage, and it doesn't have any centralized authority. It functions as a DAO and has a few governance protocols. And basically, its curve is basically defined. It's like a combination of X into Y is equal to K, and X plus Y is equal to C. So the X plus Y is equal to is like a one-to-one mapping curve, like a straight line. And this, I don't think I can derive this, but this is how it is derived, as mentioned in the white paper. So as you can see, this purple or blue, this blue curve represents the curve's curve. And initially it is loaded with 5 Y tokens and 5 X tokens, which is basically one-to-one mapping. And you can see over here, it is slightly, straight. That would mean that, there's low to low negligible slippage. So if you were to go outside this, then you can see that it will also go to an infinitely large amount. So, but that's not because of curve, but rather what's happening outside. So as long as it is priced similarly, that is one-to-one ratio, curve swapping will work without much slippage. And this is how it would be. So if I were to swap DAI to USDC, I would have almost very less slippage as compared to what Uniswap had. So that is where the term hyper efficiency comes into place. And you can see that they have this thing routed to Tree Pool. So Tree Pool is sort of their flagship pool that has DAI, USDC, and USDT. And then, so Curve basically has a lot of incentives. That is, the fees for trading is very less compared to Uniswap. However, you get a lot of rewards and a couple of interoperable tokens that you can use with other DeFi protocols. I couldn't understand a lot of it, so I can't get into the details of it. And then we have this CRV tokens. So these are really important because initially Curve started out as a centralized, they had a centralized authority, and then they turned into a DAO. And these Curve DAOs are responsible for the governance. And these tokens are, they're also given as rewards for liquidity provider. It, gives more incentive, that is more than the rewards. You also get some sort of ownership. And I think right now you can use CRV tokens, lock them, and you can propose changes, and you can use them. So basically, for all the liquidity providers, you basically get rewards based on a gauge vote, and you can basically vote what kind of rewards these pools should give out, and that is where we CRV tokens are really useful. And as of now, I think people who hold these CRV tokens are also bribed so that they can give out incentives for different specific rewards. So that is all about Curve. So yeah, any questions, something, or was I too fast?
Yeah, I have a question, Faisal.
Mm-hmm.
Yeah, the question is that in Curve Finance, can a liquidity provider make a liquidity pool of three different assets like basic, essential, and tokens?
Uh, yeah, I don't know about that. Yeah, I guess I didn't research about that. I basically searched how it functions and how the AMM functions. So I don't know if you can do that. But yeah, I think they have a thing called three pool where you can, I don't know, you can deposit something. So yeah.
Okay.
Correct. Thanks, Faisal. I think next would be Abhishek. Abhishek, you're ready?
Yes, yes. Thank
Cool.
you. I will share my screen. I hope I'm audible.
Yeah, you're audible.
Yes, so I hope my screen is visible. Yeah, so,
Yeah, it is visible.
1 inch. Sorry, I just closed that tab. Yeah.
No worries.
So, ठीक है. Yeah. So my topic is 1 inch. Earlier, when I thought before the fellowship, when I thought about 1 inch and its tokens, I thought it was something related to gaming or NFT. But what 1 inch stands for is it optimizes your trades across hundreds of dexes on multiple networks. So as Fazal and Roshan, they presented Uniswap and Curve, which are basically dexes. So what one inch is basically, it is an aggregator of dexes. To term it in layman, like in layman terms, so every dex can have, based on keyword tokens do they have in abundance, they can have varying price for different tokens, basically based on supply and demand, and that introduces some kind of arbitrage opportunity if you are into it. So what 1 inch does is it basically aggregates it, like, so if you have to do the one inch work like manually yourself, what you would do is you would open individual tabs for every dex like that you have come across. So it might be Curve, it can be Uniswap, and then you could scan for the prices of the token that you want to swap, and then the cheapest price that you get, you'll just make the trade for it, right? So this is basically what 1 inch solves for you. It basically is a decentralized exchange aggregator that connects several dexes into one platform. So basically it will give you some kind of route, like the most efficient route for the tokens you want to swap. They also have they are basically governed by a DAO now, so they have the 1 inch token is basically for their governance token to propose like give proposals over improvements of the utility of 1 inch token. A traditional, like whenever you go to 1 inch website, whenever you want to so basically here we want to convert an ETH to wrapped BTC. So what you will do is you'll just enter the amount of both and you'll get this route. So what it does is it basically splits your you know so maybe you want to convert 10 ETH to any other token that you want. So it will split it basically and take different routes to convert, like to get the most efficient conversion for you. They called this algorithm of theirs as Pathfinder. And there's one more thing which is called route aggregation, which they do. I think we'll like cover that more later on. So main responsibilities of any DEX aggregator, like be it 1 inch or any other DEX aggregator in general, is so they need to give you the most efficient price, so better than a particular DEX basically. So it should like you should always like you'll always like it should like better like whatever token you want to, you should like close your eyes and you can swap your tokens, knowing that you'll get the most efficient rate and you don't need to use a particular DEX for this particular token whatever you're trading for. And then often if you're like doing a large trade, right, so if you're using a lesser used DEX, then the price impact might change the like maybe increase the price or like may affect the whole DEX itself. So this will the DEX aggregator is supposed to break your so 1inch and like basically other DEX aggregators as well are basically supposed to break your transaction into such small pieces that it does not affect the performance or the price of an individual DEX itself, and then also it reduces the probability that you will have a failed transaction. Uh, then we'll talk about its adoption. So right now, I think most people only know Uniswap and Curve, and but like the traders who are like pros or like who do a lot of trade, like the ones that trade bigger amounts of tokens, they actually use DEX aggregators, and like we are seeing more adoption for this. This whole thing is kind of new. Like I think it was started in 2019, so that's kind of new in that
Yeah, just to give a heads up,
aspect.
I think it was one of the projects at ETH India as well.
Yeah, I was actually yeah that. So
Yeah.
again, I'll go to diving deeper. So I wanted to know how exactly this Pathfinder, like what basically the algorithm is. So I actually searched on what how does path 1inch Pathfinder work. I did a bunch of other permutations, but yeah, basically the algorithm that they use is said to be proprietary. So I actually went to their contract that they have deployed and looked at it. So there also I did like like I searched for key what exactly is written there. So if you see, so they have a bunch of interfaces. So basically I'll not go there because of time, but so they have these integrations with different so they have code so they have interfaces of Uniswap, Curve, and other things. But what they do is they just finalize it through the contract. The other, like the part where they finalize on which, like what route to take, is still hidden. So I'm not sure. I still have to, like, the contract is I think around 2,500 lines. So I just took a vague look about top and like just did some pathfinding thing and just search for pathfinder and like related words, but could not find it. So I'm still reading on it. Scope for improvement, like how can the DEX aggregator be improved? So basically, if we can connect centralized exchanges and decentralized exchanges both, right? If it can also aggregate centralized exchanges with it, that would like improve the price ratio for the users at the very least. So that is what initially I thought. Then I read a bunch of blogs, and they actually have this in their in their coming release. So they are like planning to their algorithm itself has scope to improve, yeah, to expand to include centralized exchanges as well, like Binance and everything. Yeah, and as Aniket said, it was actually created. This project actually was created during a hackathon. It was ETH New York in 2019. Yeah,
Yeah,
I
I think
think
like it somehow overlapped. It was built at both places. Something. I think it was created at ETH New York and then eventually taken at ETH India. I'm not really sure,
yeah.
but yes, it was something on these lines. And they ended up sponsoring Etherpunk as well. Pretty old.
Okay, that's yeah due to me.
Yeah, that's the circle of life. Yeah.
Awesome. Yeah, I think any questions? Anyone?
Mm, Well, if no questions, then I think we can go ahead. Vaishnavi, I think you can take up next.
Yes, okay. Is my screen visible?
Yeah, it is.
So, first, the essential question: why do we need crypto in our lives? It is basically a gold standard for digital currencies. So, what's my bad? Excuse me. So this is Vaishnavi Dasika, and this is my take on Reflexa Finance. And it's a decentralized and non-pegged stable asset that defies fiat currencies. Fiat currencies are the currencies that are like our Indian rupees or USD dollar. And what is non-pegged? Non-pegged is something that is not correlated with an arbitrary parameter or a constant. So the introduction is, why do we actually need stable coins? These are a great collateral source for DeFi protocols than ETH or BTC because of them being stable and not being volatile. And they can also be a great way to store value than with an embedded funding rate. So what Reflexa Finance does is that it provides a platform such that anyone can use their crypto collateral to mint stable coins. So, reflexive finance is a low volatility, decentralized finance collateral intended to create a stable and secure foundation for DeFi ecosystem. The company's product is a volatility dampened synthetic instrument that uses control theory in smart contracts and to automate it. So basically, what control theory is, it with help of feedback, it influences the behavior of the system to achieve a desired goal. This desired goal being to make this stable coin even more stable, to put it utterly blunt. So this follows the same chart patterns as underlying assets, but with low volatility and helping businesses minimize investment loss risk. So these are certain use cases for the RAI token. What RAI token is, it's a reflex index token. It is an Ethereum token that aims to maintain a stable value. So one thing that really interested me is that it can also be used as a synthetic asset. What synthetic assets are, they are the assets that can be correlated with real-time assets. And there are also unique money markets and stacked funding rates, digital brainstorms, and there are yield aggregators and sophisticated arbitrators. So this is basically what they quoted from Rai's white paper. So what they essentially want to do is to make it governance minimized, decentralized, and to modify the target value of the native collateralized asset. And it is also aimed to be universal and a collateral without with less fluctuations. So it is also an alternative to current Oracle and governance structures. So it is all to bridge with other protocols. It has also come up with multi-chain RAI. So it has protocols with Polygon, Solana, Phantom, and Avalanche, Arbitrum, Optimism, and so we can officially bridge our RAI stablecoin and NFTs and through other blockchains. So why do we actually need this Reflexive Finance account? This account gives us ownership and authority to the ETH and RAI that is provided in the Reflexer app. So it also gives us with the proxy. What a proxy does is it helps us like establish and run multiple contracts at the same time. Without proxy, you can only establish like a single contract. So this is what proxy does. And how this account works is by providing this proxy and also by providing this ownership within the app. So
cool. Vaishnavi, if you can take the next 30 seconds to 1 minute to just sort of conclude.
sure.
Yeah.
So this RAI stable coins are built on a GEB framework, which basically explains this. And there are also risks for building on this GEB framework that it has like smart contract bugs, it has issues with admin keys, and PID controller is like it tries to maintain like ideal optimum volatility reduction policies, which is not essentially very practical. And what Reflexive Finance is trying to do is to build better stuff on PID controller aspect. And it is also difficult to deal with the suboptimal parameters because of this. And additionally, if you want to check about ungovernance, it is GEB governance minimization, so that the people and the community members involved in this ecosystem can have their own authority and say. And this is essentially a pathway for governance minimization. And also check out for the Money God League. It is an initiative to bring about non-pegged stable assets into mainstream. And these are my references. Do check them out. They're amazing. There are also Reflexive Finance labs, which you can go through how GEB works and how RAI stablecoin works. So that's about it. Thank you.
Thanks a lot, Vaishnavi. Really love the presentation. Yeah, like we'll be sharing all the presentations with everyone. I think that should be really helpful. Any questions, anyone? Cool. Don't think there are any questions. Thanks, Vaishnavi. I think next we can go ahead with Jayati.
Yeah, I'll just share my screen.
Jayati would be talking about Insta app. Nice.
Okay, so my presentation, I'm audible, right?
Oh, yeah, you're double.
Yeah. Okay, so my presentation is on InstaDapp, and it was founded by brothers Samyak and Soumya Jain, who are both in their 20s currently. So it's quite a success story. They actually incepted the idea during the ETH India hackathon in 2018. And they were during the hackathon, they were required to use MakerDAO, which was new at the time. And since then, InstaDapp has grown at a rapid pace to now support almost all the major DeFi protocols that we have, like Aave and Compound, DYDX, Curve, etc. So, and last year they also released their governance token, INST. And while I was making this presentation, they were among the top 10 largest DeFi entities on DeFi Pulse with a total value logged of 1.46 billion US dollars. This is not their highest. I think it went over 7 billion US dollars, but that was the current
This is as per
value.
the bear market. Yeah.
Yeah. Is basically InstaDapp is an asset management tool. Before InstaDapp, users would track their assets and collateralization ratio and all the other trading parameters manually. But InstaDapp introduced DeFi smart accounts, which completely changed these patterns, and it enables users to keep track of their assets and transfer them across protocols with a single click. And it also simplifies development of the DeFi ecosystem for dappers, because they released their DSA SDK, which enables even JavaScript developers to build complex DeFi applications without having to code Solidity smart contracts, or without having to worry about expensive audits for their smart contracts. I'll define that later. But so the DeFi smart layer, or DSL, has three major components. You have connectors, DeFi smart accounts, and authority. So connectors are just standard modules which will enable interactions with the major DeFi protocols. So, and DeFi smart accounts, they are the major focus, or you would say the major innovation that InstaDapp brought along, because DeFi smart accounts are smart account wallets, which are more powerful than the regular MetaMask wallets that we have. So in our regular user wallets, we can only perform a single transaction in a single step. But using smart contract accounts, you can club together multiple different transactions and execute them in a single click. And with DSAs, you can club together cross protocol transactions as well. And when you execute them together, the gas price is lower. So it's very efficient. And so the DSA technology abstracts away the complexity of cross protocol transactions. And then authority. So I'll also explain this in the next slide. So every user on the InstaDapp has a DeFi smart account, and you can have multiple smart accounts using the same MetaMask or Ethereum address, same Ethereum address. And you can use different accounts for different purposes. You could use one account for trading, you could use another one for savings. And before InstaDapp, you would have to create many different accounts on Web3 wallets, and then you would have to manage them separately. And that's a cumbersome process. But using InstaDapp, you can use one Ethereum address to have multiple different smart accounts. And you can also set multiple owners for your smart accounts with different levels of permissions. And this is the authority component of DSL. So these permissions, they can be customized up to the connector level. You can have you can have one person managing your investments. You can have one person just different purposes. And yeah, right. Also, when you have multiple owners, it minimizes the risk of losing your assets. So that's a very important point. You won't lose your funds. And then we have this DSA SDK. So what they do, they quoted it as the start of low code or no code movement for DeFi. And that is because they introduced this DSA SDK, which is in JavaScript, and you would not require any knowledge of Solidity to make a working DeFi dApp, because using this you can. So the way this works is that we have spells. Spells denote a sequence of connector function calls. You would instantiate a spell, and you would add these different functions to it, and you can execute them in one go using the cast function. So for example, if you and these you can club together cross protocol transactions as well. So it's very powerful, and it will make development in the DeFi space very much simple. So as for the use cases, so your imagination is the limit. You can come up with applications that will involve complex cross-protocol transactions, and you can easily execute them using the DSA SDK. And that was their goal. They want all front-end engineers to use the DSA SDK for development of dApps. Also, their Discord community is very active. I was very much overwhelmed by the frequency at which they release new upgrades and features. So do check it out. That's all.
Awesome.
Thank you.
Thanks, Jayati. Any questions, anyone? Okay, sounds good. Jyoti, you can stop sharing the screen. Arka, you want to go next?
Yeah. Can you confirm if my screen is visible?
Yeah, it is visible now.
Okay. So guys, I will be talking about the pool together protocol, which can be thought about as a crypto savings account on steroids. You'll be understanding the why I called it as a crypto savings account on steroids in the following slides. So simplifying it, what pool together does is that it is actually it's a no loss saving game, where the main goal is to incentivize people by to save money by rewarding them with a chance to win a big payout. So it's a no loss saving game because you deposit your funds and it is totally safe, just like in banks. And on top of that, you have an opportunity to earn prizes, get rewards as well. So actually your capital is safe, and you can be rewarded as well. So coming to the governance, it is a decentralized and autonomously governed system, and any changes that happens in the protocol, it is proposed and voted by token holders of the pool token. And coming to the main product of pool together, these are the prize pools. And what happens in the prize pools is that people deposit people actually stake a token to be eligible for a prize. And the distribution of prizes occurs totally randomly, and they use chain-link data feeds for that. There are two paths. One is the compound prize pools, another is the stake prize pools. Now, coming to how does the pool together works, what pool together does is that it collects all the depositors' funds to earn interest by lending it to DeFi protocols like Aave, Compound Finance, and after getting the interest on the lent money, they use it to pay rewards daily, weekly, monthly to the depositors. Now, actually, it is not much different from protocols like Anchor, but what Anchor does is that they get the interest using DeFi, but the interest is evenly distributed to the depositors. But a pool together makes it a little more exciting by adding the factor of like they distribute it randomly. So there might be days when you get rewarded on multiple days, but there might be a lean patch as well when you do not get any rewards. So it's kind of a lottery, but they are only winners because your capital is totally safe. So when any deposit is made to the pool together, that deposit is automatically routed to protocols like Aave, and it starts earning interest. So the pool token is used to like vote on matters like adjusting the number of winners, launching new prize pools, implementing scaling solutions and all. And any changes that happens within the protocol, it's voted by the pool token holders. But as I said, there is not much risk associated with your capital. But still, there are some like protocol dependency risk, because pull together is using several other protocols as well. So one of the risk is that one of the integrated protocols can fail as well. In that case, you might lose your money. But pull together mitigates the risk by like collaborating with only highly reputable and well secured protocols. Another is the smart contract exploit risk, which stays in most of these protocols. That there might be some bug and all, but pull together tries to mitigate it by using third-party smart contract auditing for bugs, and also they have a bug bounty program to incentivize people to disclose any bugs and get paid for it. Coming to some highlights about the pool together, one is that we might be skeptical about the fact that sharks who have loads of money, they can deposit more funds and increase their chances of getting rewarded. But pool together, what it really does is caps the number of prizes you can win. So for using that, those with less capital can also have a good chance of winning prizes. Also, there is a pool together pods where like a pool of small investors are created, and these pools are then randomly selected for prizes. So here our chances of winning is increased, and then we get a share. If our pool finally gets some reward, subsequently we get a fraction of the prize as well. And third point, it uses Chainlink's VRF to improve decentralization and trustworthiness, because it does it selects the winners totally randomly. So that's all. If you have any questions, you can go ahead.
Any questions?
Just a general question. Why is the randomness needed? Like, what's the need for that?
Like if there is no randomness, like then you have to distribute the funds to a specific number of like depositors only, and that might be so there's might be some criteria of choosing, right? So I think they chose it randomly, and also capped like how many prizes you can get daily, to improve chances that people with less funds also get an opportunity to win, maybe.
Okay. Okay. Thanks.
Thanks, Arka. Great presentation. Devansh, you want to go next?
Yeah, sure. I will just share up my screen. Just let me know, is my screen visible or not?
Yep, it is.
Okay, all right. So my topic is superfluid. As you can see, it got a term fluid, and we know what fluids are. Like, it has tendency to flow. And since it's a DeFi protocol, you know what will be flowing. So I will just go ahead. Superfluid is a smart contract framework that introduce innovative way to move your digital values. So normally on blockchain, transfers are settled in a sequence. So in order to send an asset, you must like first wait to receive it in your wallet. So what Superfluid does is like you can stream those assets. So streams are like just constant flow of transactions that are execute automatically every time a like new block is minted on a blockchain. So what Superfluid consists of? So Superfluid consists of four things: super tokens, super agreements, super apps, and Superfluid host. So what these are like, I will go with super tokens. So super tokens are basically your traditional ERC20 tokens, but on top of it, it has Superfluid protocol to work on. So it gets the tendency to flow. So tokens will be flowing just like what in a stream. So in order to do that, it has to integrate with these agreements, which are super agreements. So super agreements are traditional value transfer functionality that super tokens have. So when an account engages in a like super agreement with another account, it actually agrees to have its super token balance modified according to the rule that super agreements hold. So next is super apps. So super apps are just smart contracts that inherit super fluid functionality. So it actually gives the ability to react with super agreements. So uh, how this ability to react it happens. So these smart contracts have callbacks, which provides the ability to create, update, and delete these based upon the logic that you provide in the smart contracts. So now there is a superfluid host. So superfluid host is, as I can say, it's a centerpiece of other which supports, which actually connects super tokens, super agreements, and super apps. So you can say like when an account interacts, it actually doesn't interact with these super agreements. It actually interact with this host, and this host will interact with with your super agreement and your super apps to indulge in a transaction in which super tokens will be flowing. So the whole architecture is based upon the superfluid host. So now the potential use cases of this protocol. One I can say is for blockchain games, where you can, like, if you play Clash of Clans, you can see there are some in-game assets which are gold coins and elixir, right? So if that game is based upon blockchain, so you can use superfluid protocol to modify those assets. So in real time, you can see the gold coins and elixir you are collecting. It's flowing in a stream. And another thing is immersive itemization. So if you are using an in-game weapon, it can get degrade, or you can improve based upon how much you spend time with it in taking care of it. So these two can be done in blockchains. And the thing is money streaming. So money streaming is what the flow of money, if as the name suggests. So it works in streams. You can flow, like you can interact with these super tokens, and you can transfer in streams. So use case of money streaming is in DAOs. So streaming salaries allow DAOs to set a yearly or monthly amount to transfer, and then these funds move automatically in a fixed rate that is set up by your DAO. And the last thing is NFT streaming. So Superfluid has actually created an ERC 721 extension to add a admin role to create a super user. So if uh, that super user will get a token ID, and he can just rent an NFT, and that uh, actually redirects the stream to the new owner. So this actually reduce the number of manual transaction needed to set up a stream, and the transaction will be frictionless. So that is all, and I have attached the official docs of Superfluid in the link. So I will I will tell everyone to refer that for like more in-depth knowledge. Thank you. So if
Good.
anyone have the any question, you can ask.
Sounds good. Thanks, Devansh. Any questions? Cool. Actually, we also have Sunny from the Superfluid team. If anyone wants to go more in depth on that, feel free to ping him on Discord. And I'm sure, I think um, Chinmay from the Bidler track is also closely working with Superfluid on the protocol. So do interact with them. Cool. So okay, just to give a quick check, we have 9 more fellows to go. Maybe if possible, we can extend it. Otherwise, we'll do it on Friday. But ideally, we would sort of want to wrap it up today. I think we can go with the next person. I think Jayesh is on the list. Jayesh, you want to go next?
Hey, hi, just give me a second.
Yeah.
Right, so my protocol, so to say, was Zapper Finance. Although Zapper is not a DeFi protocol, it's something that DeFi like really needs, and that is Zapper, in a sense, is a tool to let you get into DeFi very quickly. and manage your portfolios through one single site. So yeah, let's look at what Zapper is, why it is, and how it works. So DeFi is really not beginner friendly. It's fragmented into zillions of standards. Like we have ERC20, and then there is Aave with their A tokens being streamed into your account, like their balance increasing every second and stuff. Uh, every protocol that you interact with, you have to give your allowance to certain tokens, and these sort of transactions add up to a very large overhead for a new user, and it gets kind of overwhelming because you don't really know what you're doing. Some sites ask for like huge allowances, and yeah, it's kind of scary for someone who's new. And yeah, just there should be an ability for users to just get into DeFi in one transaction and not worry about, okay, this is an approval, this second approval, get me a subscription. All right, now I will go and invest. So yeah, so this is where Zapper comes in. Zapper is making DeFi more accessible to everyone using their Zap contracts. Their second very important feature is aggregating all of the DeFi data. So they pick data from various protocols like DeFi or Aave and stuff. So they aggregate all of that data and show it to you in one single screen, so that you don't have to go through each and every screen again and again and again. And at least for the most part remember ki okay, this is a protocol I invested in, because most of us are in it for the technology, and we sort of forget what we had invested in. So that can also happen. And yeah, they have app recipes. We will also look into this. So touching upon the features, Zap contracts are intended for newbies and even amateur level investors who can directly zap their investments into existing protocols. So what happens is that, let's say Aave, they have created smart contracts for users to zap their investment into Aave. So generally Aave investments is like a 2 to 3 step process, but if you visit Zapper, it will just show you a bunch of tokens and the protocol. So if you are looking for Aave, it will show you, okay, USDC for Aave, and then it has its APY written on its side, uh, which tokens you will get in return, that too, and you have to just approve and transact, and it's done. You don't have to go to Aave, you don't have to learn about Aave and stuff. It's obviously recommended that you do a little bit of research before you go and invest, but yeah. So see, so this is like depositing USDC into Aave V2. So if you have 6 USDCs and then you just approve it, confirm it, and it's done. So these are like a few tools that they have listed over here. The second most important feature, as I said, was Zapper Studio. Zapper Studio is what allows Zapper to be really amazing for giving their service to all of these users. Why? Because Zapper follows this concept where they have put out a template which users can just fork in minutes, and then they can add their own protocols to Zapper. So let's say I have a DeFi protocol. Uh, let's say its name is NSB. So NSB is my DeFi protocol. I just go to their studio. I find a relevant template that I want to put on Zapper. So there are various things that you can put onto Zapper. We will just list them out later. And then I just edit a few things out. I swap out the contract addresses. I provide, okay, this is the contract position, and I just want to show the user this on Zapper dashboard. And yeah, I just submit this pull request to Zapper repository, and then when they review it and it gets merged, so whichever user has deposited their tokens into my DeFi contract, they will just show up on Zapper. So it's that easy for all the developers. So yeah, so WBTC, WETH, if these are the smart contracts or the tokens that you have, all of these balances and labels and these things can be configured as per like this template that they have given. Portfolio tracker. So portfolio tracker is like very essential in DeFi. Beginners and even pros tend to forget ki, okay, this was something I invested in. So this is something that I have taken a screenshot of. This is a portfolio. And you can see here that DeFi Finance, just to give a little context, DeFi is a DeFi aggregator for liquidity pools. So yeah, so these are the liquidity pool positions that I have invested in. So this is my USDC, and we can configure actually. Okay, the label must be my USDC. It should show its real balance here, or the amount of tokens that it has stake. Or so this is the balance. This is the current price of one token of my USDC LP. And yeah, so if we expand that, what would this look like? So all of these things are configurable in the Zapper Studio repository. You just have to change a Next.js file, and that's it. So all of this is written in Next.js. All of it is JavaScript. So very easy for developers to folk and do stuff on it. They also have a public API for balances. One of the most challenging bit I faced while developing a few DeFi projects in the last 6 months is to sort of fetch balances for tokens, or even images for tokens or metadata. So if I want to fetch the image for USDC on Polygon, how would I do that? I really don't know. I still don't know. I'm clueless. So Zapper gives us solution for that. They have this API where you can fetch a user's balance, or you can just fetch metadata for any certain token that they have registered with them, or NFTs. They also support NFT Merkle drops. So if you have an NFT drop that you have planned, and you have a bunch of users, you can just submit that data to Zapper. They will cache it, and whichever user claims your airdrop can view your NFT in their portfolio dashboard. So just taking a look at what the dashboard looks like. So this is what it looks like. This is the NFTs tab. I don't have any, so there's nothing shown here. They also have a history tab where you can keep a track of what comes into your account and what's going on. This is like spreading across multiple chains: Arbitrum, Avalanche, BSC, Ethereum, Phantom, etc., etc. So yeah, this portfolio is like super vast. So here's Beefy, Aave. They also have support for DHedge, I guess. So yeah, they have a lot of protocols. They have also an inbuilt swap, a bridge that they operate on their own. And yeah, these are the two things that were the most important: deposit and earn. So for newbies, you can just come here and approve and deposit and get done with your investments. So yeah, that's Zapper for everyone. Uh, yeah, so if you have any questions, I'm here.
Folks, any questions?
Yeah, it's a simple question, by the way. I think Jayesh can answer. Yeah, the question is that if I'm investing in Zapper, right,
Mhm.
and I'm investing through making a pool, right? So, what kind of loss can a investor can go through when making a pool in Zapper?
Okay, so what 1inch does is 1inch aggregates all of the DeFi uh, liquidity pools, and then it shows you the best route to swap your tokens. So that's something similar Zapper does. Zapper is like taking all of these protocols and then showing you one transaction to get into these protocols. So if you want to invest in Aave, you can invest through Zapper. You don't have to invest in Zapper. Zapper is like a provider that's like bridging the gap of user experience, bad user experience. So you don't have to invest in Zapper. All of the risks and losses that are subjected to the user are indeed based on the protocol that you're investing in. So example here, Aave. So no additional risks are added to the experience.
Okay.
Good. Pretty cool presentation.
Thank you.
Yeah. All right, folks, I think I'll take a call here. So it's like already 9 o'clock. We are still, I think we have 8 more to go. If you're okay with it, we can do it on Friday instead of rushing through all the 8 presentations right now. I'm sure like you might have other commitments as well. Is that something which would tamper with your current week's assignment, or is it something we can do on Friday?
It could probably happen because this week's assignment is also a little vast, so to say, the social media tab. It could get messy in some sort of situation.
So everyone's ready to sit for another half an hour, or what is it?
Up to everyone.
What the other says, Friday or like we'll finish today? Sunday. Okay.
Sunday is kind of a stretch, na?
Sunday.
I was thinking like after all of these 3 weeks, I will finally have a weekend this week.
Oh, what you can do is maybe let's do it on.
Leave the it.
No, everyone has put in efforts in the presentation. I think people are, I think I can see more Fridays in the chat if I'm not wrong. No, I can see more. Wait. Bro. अरे यार स्पैम कर रहा है
डिस्कॉर्ड पे वो पोल डाल दो चाहिए तो
I'll just see, there's 8 more to go
for the week.
8 so basically 8 into 5 40 minutes, another 40 minutes. See, I don't want anyone to drop off. Like everyone should be there on the call for all the presentations. That's the thing.
I think people have already dropped off क्योंकि वो mental call है उनका.
Yeah. I think let's just do it on Friday. What you can do is on Friday it's just 8 people, right? So we can finish it within an hour. And maybe like you can give your focus to the rest of the assignments you have right now. And obviously, like what I'll also do is maybe I'll make the presentations public as well. You can go through it at your own pace.